Hello YouTube. Are you concerned about your portfolio? Right now I'm guessing you probably are. Are you wondering if you should get out of the stock market? Maybe. Should you rebalance or restructure your investment? Or maybe you're thinking about starting to invest and wondering if now is a good time. Please leave me your comments below, and while you're at it, go ahead and hit that subscribe button. Let me know what you're thinking. What are your concerns about the stock market? Are you thinking about investing? Are you thinking about getting out of the market? Let's talk about it and make sure you make the right decision. Well, let's talk about what's happening and maybe it'll help you decide. Now, before COVID-19 came along, the stock market had been on more than a 10-year bull run, setting new records almost on a regular basis. And if you were invested during that time, you were probably feeling pretty good about your portfolio. As long as you were well diversified, your quarterly statements were probably looking pretty good. Yeah, there was constant talk about possible recession, but investors didn't seem to be too worried about it, and the market continued to flourish in spite of some things that had historically signaled that there might be trouble ahead. There had been some dips whenever there was a new threat, such as a trade war, or if the bond yield curve seemed a little out of whack. But again, investors didn't get too shook up over it and the economy rolled on. But as the virus continued to spread globally and news from China kept getting worse, all of a sudden investors started to really get nervous. And while we were all out panic buying toilet paper and hand sanitizer, the stock market was tanking. By the time we all got settled in with our quarantine supplies, we looked up and the stock market was down over 35%. Ouch. Yeah, it felt like it happened overnight, but it was actually a little over a month of steady decline. And depending on how you were invested, you could have seen worse numbers than that. Now, since then, the market has recovered about half of that decline, but some experts are still speculating that we could see another sharp decline, or a double bottom as it's sometimes referred to as. So how do you position yourself for a recovery or another decrease when we still don't know how long this virus is going to last or how much it will actually hurt the global economy? Well, the answer to that question depends a lot on where you are in relation to your retirement plans. If you're 10 years or more from retirement and you have a well-diversified portfolio, then you'll probably be okay. Although you still may need to adjust your allocations or how you are currently invested in certain areas in order to keep your risk profile the same as it was before. Right now, it kind of feels like we're in uncharted waters without a compass. This is unlike anything we have seen in recent history, and the closest thing we can compare to this is the crash in 2008-2009 timeframe. But that was different. That crash started as a financial crisis that hit banks and real estate markets first, and then it spread to other areas, but it wasn't a complete shutdown of the global economy. Now, this is not a complete global shutdown either, but it's pretty darn close. One of the areas that I have concerns about is small cap. This section of the market has historically been one of the best performing areas for growth, but it has also been one of the areas with the most risk. Small cap companies tend to carry a lot of debt as they are growing, and we all know what happens when you can't pay your debt. So depending on how much revenue is lost and for how long, there will likely be some small cap companies that won't survive. By the way, if you're not familiar with small cap, mid cap, and large cap companies, you may want to watch my video series on retirement planning. If your portfolio is set up for aggressive growth, you may want to review your small cap exposure and possibly adjust that exposure, at least for the time being. One way to do that, if you are still working and contributing to a retirement plan, is to change the allocation of your contribution. Chances are you're invested in mutual funds, so you may not be able to stop contributing to a specific stock, but you can reduce your contributions to your small cap fund. Or if you want to reduce your risk exposure but keep a certain percentage in small cap, maybe you divert some of your funds from small cap growth funds to small cap value funds. Again, it depends on your time horizon and your risk tolerance. Another area where I have concern is in the retail space, more specifically the brick and mortar retail space. Now, some businesses in this sector were already struggling before COVID-19 due to the surge in online shopping and other factors. In case you didn't know, the term Black Friday used to refer to the Friday after Thanksgiving, because that was when most big box retail stores finally turned a profit. The rest of the year they were operating in the red or were losing money. Every year it seems like the Black Friday sales start sooner and sooner as online sales claim more and more of the market. I wouldn't be surprised if we started to see Black Friday sales in August or September this year, and that still may not be enough to save some companies. For those that were really struggling before COVID-19, this may be the end for them. And then there's the bond market to worry about. Now, in general, bond prices move in the opposite direction of interest rates, and since the Fed has already lowered rates about as low as they can go, bond fund managers are busy restructuring the mix of their funds to maintain yields. Now, how bonds operate in relation to interest rates can get rather complex, so I'll do a separate video on bonds at a later date. Just know that most bond funds are aggressively managed, but their value may not change as fast as stocks or mutual funds. If you are near retirement or in retirement and you have a significant portion of your portfolio in bonds, you may want to speak to your advisor and see if that mix is still right for you going forward. Everyone's situation is different, so you need to get advice that is specific to you. The last thing that I want to talk about is how the CARES Act will help businesses and therefore help the stock market. The CARES Act actually consists of 4 parts or target areas, but most of what you've probably been hearing about only covers 3 of those areas. Now, there's the assistance for workers and families piece, which is the stimulus checks that a lot of people are still waiting for. Then there's the assistance for small business piece that has generated a lot of controversy because some publicly traded companies receive millions of dollars under the Paycheck Protection Program and depleted the funds before a lot of true small businesses were able to apply. A few of those companies have agreed to return the money, but others have said they will not because they followed the rules of the program. This program was intended to provide forgivable loans to help small businesses keep employees on the payroll while they were shut down or if their revenue was reduced by 50% or more due to COVID-19. Now, the third piece is the assistance to state and local governments. This piece was intended to help states deal with the unbudgeted expenses of fighting the coronavirus. The fourth piece, and the one that you probably haven't heard much talk about, is the section titled Preserving Jobs for American Industry. This section of the CARES Act was intended to incentivize employers of all sizes that faced closure orders or suffered economic hardship due to COVID-19 to keep employees on the payroll through a 50% credit on up to $10,000 of wages paid from March 13, 2020 through December 31st, 2020. And yes, that is up to $10,000 per employee. Also under this section of the CARES Act, employers and self-employed individuals can defer payment of their employer share of the Social Security tax. The deferred tax can be paid over the next 2 years, with half of the required amount to be paid by December 31st of 2021 and the other half to be paid by December 31st of 2022. So really they have more like 2.5 years to catch up their payment. The only caveat is that businesses cannot take advantage of both the Paycheck Protection Program and the employer tax break. But if you do the math, you can see that either program can potentially put millions of dollars into the hands of some businesses. So with all that being said, I believe the stock market will rebound nicely once people are able to go back to work and supply chains are restored or restructured. I believe the market will look a little different than it did prior to COVID-19. And a lot of that will be determined by you, the consumers. Your spending behaviors may be different after being on lockdown for a couple of months. Now, in the short term, there will be a lot of focus on pharmaceuticals as we continue to search for a vaccine. Online shopping, food delivery, streaming services, and a few other areas will see an uptick for a while. But the big question that remains is, what will the new normal look like a year from now or 2 years from now? But just know that there are enough incentives and economic stimulus being applied to ensure that the stock market is able to make a significant recovery. With that thought in mind and knowing that right now the market is still down, I believe it is an excellent time to get started investing if you're not already. Some stocks were potentially overpriced before the pandemic, so the market will correct that. But there are still bargains to be had. If you were thinking of getting started, now is the time to put that plan into action. Get help from a trusted advisor if you need it, and get that account open before you get cold feet again. If you decide to get into the market as a new investor, just know that nobody, I don't care what they tell you, nobody can time the market. And by time the market, what I mean is, obviously you want to buy low and sell high, but nobody can predict where the bottom is going to be, and nobody can predict exactly where the top is going to be. So if you're sitting around waiting and thinking, well, I'll wait till the stock market reaches its bottom and then I'll get in, you don't know when that's going to happen. And chances are you will buy at the wrong time. And if you're thinking of selling, chances are you will sell at the wrong time. So don't try to time the market. Many have tried and failed. So don't even attempt that, especially if you're new to the stock market, new to investing. Just make up your mind that you're going to start investing, open an account, start putting some money into the account. You don't have to buy something right away, but go ahead and get the account open. Start educating yourself, start doing some research, do some comparisons like I talked about. Look at how some of the stocks that you may be interested in or some of the funds that you may be interested in, look back at how they performed during the last crisis and how well they recovered or how long it took them to recover. Most of the stock market had recovered from the financial crisis in about 4 years, meaning they had returned to their previous levels in that amount of time. Now, who knows how long it will take for the market to recover to its previous levels from this coronavirus. Actually, it may not get back to previous levels. As I said in the beginning, prior to COVID-19 hitting, the stock market had been on more than a 10-year run of positive results. So, I mean, we couldn't expect that to last forever. I think it would have continued for longer had the COVID-19 not arrived, but don't expect things to go back to exactly where they were. We don't know what that new normal is going to look like. Some companies that were around prior to COVID-19 may not survive this, and they may not be there afterwards, especially if they were some of the smaller companies or if they were companies that had taken on a lot of debt prior to this happening and their revenues fell off and they're unable to pay their debt. I expect to see some companies either be bought up by other companies or go out of business altogether. It will happen. Unfortunately, that's part of the stock market and part of being a business owner. I hope none of you small business owners find yourself in that position. And I hope if you have an opportunity to take advantage of some of the stimulus funds that are available. I know it's been very frustrating for a lot of people trying to get access to some of those funds, but hang in there. Things will get better. We will all get through this together, and we can come out prosperous on the other side if we're smart about it. And finally, think about your own spending behaviors and what you will do post-pandemic. Remember, consumers drive the stock market and you are the consumers. Please take care of yourselves and your loved ones until this crisis is over, and until next time, behave well.